Hello and welcome to the Brentwood Developers Investment Opportunity webinar. Thank you so much for joining me today. My name is Carl Krauskopf. I'm the managing partner for Gold MF. And today we're going to talk about the business plan for the acquisition of Brentwood Apartments, a 12-unit apartment complex in Seattle's East Lake neighborhood. But before we get started, I'd like to run through a few disclaimers. First, I'm neither an attorney nor a CPA. I'm not giving tax or legal advice, so please do your own due diligence and check in with your own experts. In the deal room link, you'll find all of the necessary underwriting, the leasing, and all of the other documents that you need in order to make a well-guided investment decision. First, let's talk about how to actually invest in the opportunity. First, you'll navigate using your web browser to aurorasinvestmentgroup.com and click on the investor portal at the top right-hand corner of the page. That will bring you to a login or registration form. Once you're complete there, you'll go into your dashboard and you'll navigate to the Offerings tab. There you'll find Brentwood Developers as an opportunity where you can click the Invest Now button. Once you've gone through that, you'll navigate and follow the prompts in order to select which class share and investment amount you'd be purchasing. From an accreditation verification standpoint, you can also complete that within the platform itself. Or if you have a letter from a recent syndication or other accreditation verification letter, you can also send that to me and we can upload that to your investor portal. Additionally, you can DocuSign your investor agreements and you can fund directly within the portal. Now, let's talk about some of the investment highlights. Brentwood Apartments, what can I say? It's an A+ location. It's a Class C apartment. It's in a market that has high growth, Seattle, Washington. Strong rental demand. We'll talk about the return to work that the Seattle offices are now underway. And lastly, the unbeatable tenant grade. Let's talk about the leadership team real quick. My name is Carl Krauskopf, and I am joined by Augie Bukowski. And between the two of us, we have both flipped and developed nearly 300 homes over the last several years. I myself have flipped and developed 30 homes in the last 3 years. Augie has built even more. Moreover, from a multifamily standpoint, we both own and operate nearly 100 units of multifamily apartments between the two of us, ranging from Seattle, Washington to the central Washington city of Wenatchee. Property management. So we do intend and we will work with a local expert by the name of Adrian Chu. He's been a Seattle resident for over 15 years now and has owned a brokerage, a property management company, Laurelhurst Property Management, who we will be using for this, as well as he's also a developer and an entrepreneur himself. In terms of his team, what we really looked forward to and what we looked for in a property management was a team that had presence at the City of Seattle's City Council meetings, so that way we can stay well informed on what rental regulations are coming down the pipe, as well as voice our support for landlords, investors, and owners. He's also bringing tenant management, so that's everything from the tenant acquisition, lease ups, to the final walkthroughs. Additionally, maintenance, so this is maintenance calls for anything that breaks or needs fixing during the course of the tenant's residence. And lastly, reporting. We'll be working with Adrian Chu's team at Laurelhurst Property Management to put together and build out monthly investor reports, so that way you can stay on top of and stay informed on how the property is performing. Let's talk about the resilience of multifamily. Transitioning into the resilience of multifamily, I want to talk about how multifamily has performed over the last nearly 3 decades. Multifamily has performed incredibly well and is consistently on top of all other asset classes in the multifamily space from a total average return standpoint. Additionally, its consistency in terms of returns from the good times to the bad times And as we all know, we are potentially entering into a recessionary time right now. So multifamily is one of the best hedges against a recession from an asset class standpoint. From a recovery standpoint, apartments also show to be one of the quickest and strongest rebounds post-recession. And in terms of Seattle, we'll talk about some of the supply constraints moving forward, but Seattle and the Puget Sound area continue to face massive shortages in terms of rental and affordable units coming online. Now, what does this do for us? This gives us a great advantage in terms of increasing rental demand and decreasing vacancy rates. Again, we'll get into some of that later on in the presentation. Talking about the overall location, Seattle, the Puget Sound, the greater Seattle region, as you can see, there's a ton of different employment. There's a lot of geographical diversity, whether it's mountains, water, lakes, sound. There's a ton of diversity in the area for recreationally speaking as well as employment speaking. A little about the employment landscape. There is a ton, again, as I mentioned, there's a lot of diversity from high-tech employers like Amazon and Microsoft to aerospace like Boeing, all the way through military and support services like education, healthcare, and retail. We continually show a very, very low unemployment rate and continuing to have a high dollar, high salary employment rate as well. And as many of you, I'm sure, have seen in the news, that Amazon announced and is underway on bringing their employees back into the office. Now, why is this good for Brentwood Developers, you might ask? Well, because Brentwood Apartments are 6 minutes away from the South Lake Union headquarters of Amazon. Now, short commute time, that's incredibly desirable by tenants. And we'll get into some of the rent comparable from a pricing standpoint, but our units at Brentwood Apartments are going to be some of the most affordable within a 10-minute drive of the city. We have a strong unit mix, great amenities, and from a desirability standpoint, the Brentwood Apartments is going to be incredibly desirable by tenants because of it. Again, it's short commute and it's amenity base and affordability. The East Lake neighborhood itself, super close, super cute and quaint. One of the most quintessential neighborhoods of Seattle, where it is close to big town amenities, but it feels like a small town neighborhood. It's got bars, restaurants, coffee shops on nearly every corner. Great visibility into the South Lake Union and the mountain ranges as well. Niche.com rated it as an A+ from a livability standpoint. And really the only poor reviews are that it is too urbanly dense. Now, living 6 minutes away from downtown, one might expect that, but nonetheless, there are still some reviews that it is a little bit too dense for them. Now, let's talk about the tenant base. Our East Lake, the Brentwood Apartments, are AAA, A+ tenants through and through. East Lake neighborhood population is a little over 2,500. The median age is 32. Income little under $120,000, which equates to a rent to income ratio of just over 5.1. With an average credit score of 706, this means that our tenant base, generally speaking, is going to have incredibly high credit scores, high predictability in terms of paying on time, paying in full, low delinquencies, and which eventually spell low to no evictions. So again, from a East Lake, from our tenant base standpoint, we have some of the best in the city and some of the best in the country. Seattle itself has been ranked consistently as one of the largest metros for continued rental sector strength because of the population age as well as the median home price and household income. So what does that mean? It means that our housing affordability, what it costs to buy a house, is so high that it becomes somewhat unattainable for people to buy, which puts them into a position for renting. And from an age standpoint, the age of 20 to 44, those that are ideal from a renter standpoint, we are one of the highest rated markets in the country for, again, long-term rental sector strength. Let's talk about the Seattle rent growth for a second. From a supply standpoint, we continue to show that we have a lack of buildability, a lack of supply coming online over the course of the next 5 to 10 years. Where does that put us? That, again, as I mentioned early on in the presentation, that puts us into a position for continued rental growth and low vacancy rates. So from a month-over-month standpoint, we are at 0.3, which spells out to be a 3.6% annual rent increase, which is well over what we have from a projection standpoint in our underwriting file. Let's talk about the unique deal structure and why I believe that this is one of the investments of the decade in the Seattle market from a multifamily standpoint. We have a distressed seller situation. So the seller themselves wanted to get out, reposition their capital. They're a build-to-sell owner, build-to-sell developer, and they have inventory online right now that they want to, again, put more capital into and getting out of this loan itself, a non-performing loan. Also something that apartments are not his investment strategy. So again, wants to focus his efforts elsewhere in the build-to-sell market. Creative negotiations. We were able to negotiate with the seller a way that made him money and will make us money. So what was important to us? What was important to us was getting a low cost basis on the apartments. What was important to the seller was a surety of closing, as well as the prospect of being able to keep and make some profit on the back end. So what we did is we spun off non-core asset, which were the townhome lots, allowing the seller to keep the townhome lots, whereas we're buying just the apartments themselves. That gives him the opportunity to go build and sell those townhomes and retain some profit, whereas that gives us the ability to go in it at an incredibly low cost basis. We'll talk about that later on in the presentation, but we are at a historically low cost basis on a per unit, per door basis with this purchase. Again, talked about the non-core asset spinoff. We sold those, or rather we're spinning off those townhome lots, and thus we're de-risking our balance sheet, mitigating our risk, and focusing on high velocity of returns. The asset itself, incredibly strong unit mix. 8 of the 12 units are 2-bed, 1-bath. We've got a couple 1-bed, 1-bath and studios in there as well to give us a solid diversity of tenant bases. From an amenity standpoint, wow, can't say anything better than the Brentwood apartments. Right now, we've got storage for each apartment, each unit, but right now there's a lot to be had with it. They're not being charged for it, and from a usability standpoint, it's not clean, it's not pretty. So we intend on going in, doing a very, very low level amount of renovation to it, and implementing a small charge back to the tenants for utilizing it. This middle photo is a picture of one of the units that has in-unit washer dryer. Every single unit has an in-unit washer dryer. That is very desirable and very rare in this market. Lastly, we'll see here in just a second, water views. Water views of South Lake Union is one of the most under-marketed amenities of this property. You go online, you look at some of the photos, not a lot of them market that we have water views. So we intend on going in, doing a better job optimizing the marketing and really showcasing that we've got solid water views for these apartments. Some more property photos of the exterior and interior show an incredibly charming, unique vintage of a turn-of-the-century apartment complex in Seattle. Brick facade, stick-built apartment is an incredible asset here in this market. Each of the units have original hardwood flooring, which we intend on going in, refinishing the hardwoods, doing some light renovation from a paint standpoint, as well as updating the lighting fixtures, the plumbing fixtures, and the appliances in order to reach market rate rents. And we'll show here in just a second that where we intend on going from a pro forma standpoint on our rents is still well below the market rate. Value add strategy. So as I mentioned, we're going to do a common area remodel. So we'll go in, refinish the hardwoods, paint, update the electrical package, so that way when tenants walk into this space, they feel warm, they feel welcomed, and they're excited to be there. They're not just running and scurrying into their apartment. They're proud of where they feel. We'll do unit remodels on turnover, so we don't intend on going in and moving people out just to renovate and bring these units up to rent. We want to be able to have a good, solid working relationship with our tenants, offering them good quality units at affordable rates. We'll install additional revenue streams. Like I mentioned before, we'll start charging for storage units once we complete that remodel. There's also other opportunities like managed Wi-Fi, where we can go in and essentially offer higher speed internet packages to tenants at a lower rate and collect the margin. Increase to market rent. Those market rents that we're going to from a pro forma standpoint are still 10 to 15% below what we could be charging based on comparable properties. Lastly, expense reductions. Talked about some of the marketing opportunities that we can do. We're also aiming at reducing or eliminating the payroll expense that the previous owners have incurred, as well as targeting reductions in gas and some other areas that we'll go through when we look at the operating expenses. So what's the operational plan, you ask? Year one, we plan on going in there, stabilizing the property with long-term leases, remodeling the common spaces, installing some of the additional revenue streams like the storage. We'll renovate the one vacancy, as well as renovate any of the units that organically come up. We'll transition property managers and we'll improve the signage and branding. Year two, we'll continue the organic renovation process of the interior units. We'll promote in-house transfers, so that way we can create that snowball effect for when members or residents decide to move into one of the renovated units. That creates an opportunity. That creates the opportunity to renovate the other unit, and then thus continuing that snowball effect of getting closer and closer to that pro forma standpoint. We'll monitor and strategically improve the property. And lastly, we'll begin testing the marketability to exit early. So we'll go through some of the exit strategies later on, but this one I'm really excited about. Year three, property is fully stabilized. We'll monitor and maintain. We'll continue to test the marketability to exit early. And year four, we'll go to market with sale or refinance if we were unable to sell it in year 2 or 3. So I mentioned earlier on the creative negotiation, the historically low cost basis of Brentwood Apartments. So I'll draw your attention to the properties 1 through 9, the ones that are in white, and then the attention on the far right side, the per unit and per square foot basis. The average for these 9 sold over the last 3 years was about $405,000 per unit. On a per square foot basis, it was $546. Where we're buying Brentwood Apartments is just a little bit less than 50% of a discount from the average rate. That's huge, historically low cost basis. The next closest comparable you can see at the top, Cambridge Court, sold for $256 a unit, but what it shows is those units were on a 399 square foot average. So they're selling micros and studios, whereas we've got that strong unit mix of 2 bedrooms and 1 bedrooms. From a competitive rental pricing standpoint, let's look at this. Where we intend to take each of the 1 bed and the 2 beds is going to be between 10 to 15% below what we could be charging from a market rent standpoint. And the reason being is we want to continue to be competitive on our pricing so that way we can ensure top line revenue. Now, if we can push the envelope, if we can get closer to the true market rate rents, we'll certainly go there on the new lease ups. However, we want to keep in mind that we want to stay competitive and we want to stay fully occupied. So that way we can, again, maximize cash flow during the operations and get to the back end, sell it at full occupancy. So let's talk about the financial offering. We've talked about the business plan. We've talked about the acquisition itself. Now let's talk about the actual offering. From an investment breakdown standpoint, we are raising $1.2 million in exchange for 65% ownership of the LLC, of Brentwood Developers LLC. In there's a 7% preferred return hurdle to the limited investors with a minimum of an investment of $100,000. Our planned exit is 4-year hold, with the intention of going to market within that first 2 years. Targeted returns, you can see here, average cash on cash is 5%, average annual rate of return over 26%, with an internal rate of return greater than 21%. Our target equity multiple is 2x. So where does that put us in terms of a Class A share? Capital investment of $100,000 can expect over the course of the hold period to return to a little over $200,000. We'll show what the exact numbers look like here in just a second from a projection standpoint. Now, if you are in a position that you want to invest a little bit more, there is a Class B share option available. This Class B share does get a 10% premium above the Class A shares. So for $300,000, there's a Class B share available. Now that comes with a 10% premium over the equity of a Class A, over 3 Class A shares. If that's something that you're interested in, I'd love to have further conversations. Let's talk about some of the numbers. Rental income analysis. So as I mentioned before, we anticipate on getting to those pro forma numbers by the end of year 2. And year 3 will be fully stabilized with a planned exit of year 4. Now, what this does not take into account is the snowball effect that I mentioned earlier of in-house transfers. So our intent is to go in, renovate organically, and promote within, first and foremost to the tenants in the apartment, the ability to move into a fully renovated unit. Now, we can offer things like moving assistance from a labor perspective, and we'll test some of that before going to market on the leasing side of things, on the external leases. Operating expense analysis. So what I want to talk about here and draw attention to is some of the risks and some of the opportunities. From an opportunity standpoint, gas and electric right now is being charged. Charges are a little under $10,000 per year, and what's making the large makeup of that is going to be both unoccupied, vacant units. So right now we're at 11 of 12 units are fully occupied. In the previous year, 2022, the previous owner kept a good portion of the units unoccupied for intent to renovate full units. So we should see some automatic expense reduction there. Additionally, we're exploring credits to remove the gas boiler and replace that with electric heat pumps. Right now, each of the apartments are sub-metered, which means the tenants pay directly the electrical. And if we replace the natural gas heat, which is what the landlord pays, that with electric heat pump, that expense would effectively go to zero or go near zero, and have the tenant paying that. So that's why we're also giving enough headroom in the rent to allow for tenants to come in and still pay that lower rent, but have a higher charge or higher expense in their tenant paid electrical. Insurance. So from a risk standpoint, the numbers that we have in here are hard numbers with standard 2% expense escalators. Now, what could cause this to be a risk would be any kind of large natural disasters, earthquake, volcanoes, that could happen in the state of Washington that may not necessarily directly impact our apartments. However, large-scale natural catastrophes have shown to increase premiums across the board. So there is risk there. Another risk is the real estate taxes. Now, this $37,000 in year one is already adjusting for the new purchase price and the millage rate. But what it does not take into effect is any kind of additional levies put in place by the city, the county, or the state. Trash removal. What I've noticed from my site visits is that the trash removal process is very antiquated and very inefficient. They've got individual trash cans for almost every single tenant. Now, what would be more effective would be large cans, large dumpsters that are picked up on a consolidated basis, which would ultimately reduce our expense there by roughly $2,000 to $3,000. Turnover expense is a industry normalized number, and if we don't end up going through it, that's fantastic. Moving on into cash flow analysis, what we'll look at is the project level for members, as well as an individual Class A share member projected cash flow and net proceeds. So this is the 4-year exit analysis for cash flow. So as you'll see, in year one will range from 2.8% in-year cash-on-cash return, upwards of 6.3% by the end of year 4. Now, something worth noting is that first year of cash flow, what I intend to do is make sure that we've got enough reserves, and we'll do a catch-up in year 2. That is once we've gotten through the townhome construction in the backyard, as well as gotten through with the majority of the stabilization. What we intend on doing is doing a catch-up in year 2. Now, Plan C. What happens if we are unable to sell in year 2, and what happens if we're unable to sell in year 4? So the intent here is to show an example of what we would do with some assumptions in place if we are, again, unable to secure a buyer by that end of year 4. Now, right now, Sound Credit Union is the lender of choice and the lender that we are moving forward with. We've got a 5-year fixed plus a 5-year floating debt with a 2.5 spread over the 5-year treasury. Now, what we intend on doing, again, is to sell within the first 4 years. However, if for whatever reason we do need to refinance, we plan on refinancing in year 5, getting to a position where we can return some capital via cash out refinance, and then holding for an additional several years. Now, what would cause us to require a refinance instead of a sale is if there are a lack of buyers at the point, or if for whatever reason that, again, we need to go forward with a refinance. Let's talk about the exit valuation and the cap rate analysis. Quarter 1, 2023, the average cap rate, the average apartment selling in Seattle sold at a 4.1 cap rate in quarter 1, 2023. Now, if we extrapolate and go to year 5, i.e. year 4, i.e. quarter 1 of 2027, where we project an exit of a 5 cap, that's how we get to the valuation, and that's how we get to our investor metrics. Now, what I'm showing here on the screen is going to be some metrics and graphs from Kidder Matthews, a local brokerage and a local expert on the apartment space, showing building sales from a dollar perspective, sales volume, and cap rate. This is based on King, Snohomish, Pierce, and Kitsap County. The red is going to be King County, which is where Seattle is going to reside. So in quarter 1 of 2023, that's where we get the 4.1 cap rate for all apartments sold in the city of in King County. Now, what I also wanted to show was cap rate decompression and price per square foot sold over the last several years, including a view of the Great Recession. So what we can see here is in 2007, when cap rates were the lowest at roughly 5.5, there was a 70 basis point increase to properties sold at 6.25. Now, how and why is that important? If we look at the data from 2022, when cap rates were the lowest, if we were to extrapolate and say the same thing were to happen as the Great Recession, a 70 basis point increase, our average property sold or average cap rate is going to be a 4.9, which is still 10 basis points lower than what we project to exit at in year 4. From an exit strategy standpoint, I wanted to show all three of them up on the same page. Plan A, which is the base case scenario, is a 4-year exit. So this is where we're going to sell at a 5 cap. After 4 years, we're going to stabilize the property. We're going to do the interior remodels, and we're going to, again, sell at a 5 cap or $4.5, $4.6 million. Now, the price per unit on these is going to show at what's still below what properties are selling for on a per unit basis today. So today, units are still selling at $405,000, $405,000 per unit. In 4 years, we can expect what we're projecting is a sale at $383,000 per unit. So still below the market average. From an internal rate of return standpoint, we're expecting and projecting a 21% internal rate with a 2x equity multiple and a 5% cash-on-cash return. Now, if we look at a plan B, this is the accelerated sale process and exit in year 2. Net operating income is going to be slightly adjusted downwards because we won't have the full run rate and getting to the stabilized position. From a cap rate standpoint, we're going to be a little bit less decompressed, so we'll be at a 4.8, which leads us down to a slightly higher internal rate of return, lower cash on cash, and a slightly lower equity multiple. Why and how I'd like to prioritize this is because of velocity of money, being able to get in and reposition capital, and be able to de-risk our balance sheet, both as an organization as well as individual investors. Plan C is what we just talked about, the 5-year refinance and 7-year exit. Net operating income is going to be appropriately adjusted upwards. We're going to continue to decompress our cap rate. Our average sale price per unit sold is going to be marginally higher, which is going to equate to a slower velocity of money, a lower internal rate of return, but an adjusted upward average cash on cash return and a higher equity multiple. Now, what this is going to show is that at the end of year 5 or at the end of the refinance, we'll have a liquidation event of about $705,000 projected, and then at the final sale, a $1.56 million return, and that's going to be a portion of the initial capital plus appreciation. And again, just to highlight, Plan B, that 2-year exit, is what we're going to be favoring and what we're going to be targeting. Now, without further ado, I want to recirculate some of the next steps. From a investment standpoint, you navigate to aurorasinvestmentgroup.com. You can also click on the link that's here within. The investment details box at the top right of these slides will also take you directly into the investor portal. So you'll follow the prompts to invest now. You'll get your accredited investor verification process. You'll DocuSign, and you can even fund all online. Now, if you'd like to do it another way, we can also work via wire instructions. Now, if you are moving forward with the wire instruction process or the wiring process, please make sure that you do call me personally, 206-601-1795, and confirm that the wire instructions are accurate. Now, where we're at from a timing perspective is we're looking at closing in the month of June. We've got about another $300,000 to $400,000 funding gap. So looking to close out on another 3 or 4 Class A shares. I am personally going to be investing about $100,000, a single Class A share as well. And I'm really looking forward to investing alongside each of you. I appreciate everybody's time. Really looking forward to closing this property, repositioning it, and exiting the property, as well as, again, getting returns and investing alongside each one of you. Thank you, everybody. Enjoy the rest of your day.